Good morning, and thank you for joining us. My name is Brent Ledbetter. I'm a Senior Vice President focusing on our equity solutions here at Research Affiliates. It's my pleasure to host today's webinar, Buy High and Sell Low with Index Funds. Products tracking market capitalization indices have exploded in popularity due to their ability to deliver an average return at a low fee. However, as the title of today's presentation would suggest, cap-weighted indices are not without their flaws. And that brings me to today's presenter and topic. I'm pleased to introduce our founder and chairman, Rob Arnott. Rob will review recent work he and our research team have conducted, quantifying index trading costs. He will propose some fixes to address these costs and also address the impact of indices' large holdings of expensive companies, a popular topic with the quote-unquote FANG stocks of Facebook, Amazon, Netflix, and Google, often in the news. We hope you will find this webinar engaging and informative. While the audience is in listen-only mode, we would like to devote much of our time to answering your questions. So if you have any questions, please feel free to submit these in the right-hand dialog box. With that, Rob, over to you.
Thank you very much, Brent. Having been originators of the fundamental index concept, we're not opposed to indexation. We think indexing is a sound concept, a very natural starting point for investing for those who haven't made decisions as to what kinds of active bets they want in their portfolio. But we've been growing increasingly concerned at what we think is overselling in the indexing community. Indexes are not without their weaknesses, not without their flaws. And when you look, the closer you look, the more evident some of those flaws are. These aren't severe flaws, but they are measurable, and they are statistically significant and economically meaningful. And perhaps most important of all, they are fixable. Let's open with a little look at the history of indexing, because that forms a foundation for much of what we will be discussing today. The first index funds appeared in 1973. There were institutional products offered by Dean LeBaron and Bill Faus. Bill Faus is usually credited as the originator back in 1969, but his first index funds excluded all below investment grade stocks and systematically underperformed the index until he decided in 73 to actually track the index. Dean LeBaron beat him by a few months, starting the first index funds, true index funds, in early 73. Jack Bogle launched Vanguard 500 in late 73. This was broadly in response to mounting evidence that most active managers underperform, net of all fees and implementation costs. Now, there's a lot of academic support for indexing, and I think it's this academic support that discouraged people from looking at alternative weighting metrics other than market cap. Begins with the efficient markets hypothesis that assumes that current prices reflect all available information. If the prices are all correct, why bother picking stocks? But if the markets aren't efficient, a thoughtful investor can win. Now, advocates of indexing are correct in pointing out that an active investor can only win if there's another active investor, a losing active investor, on the other side of their trades. That's one thing that the active community doesn't like to acknowledge, but that also is true. The capital asset pricing model was introduced first by Jack Traynor in 1962 and then by Bill Sharp in 1964, demonstrating that the cap-weighted market portfolio can't be beat on a risk-adjusted basis. Now, this is mathematically true if some heroic and false assumptions are made. It's simply a mathematical truism, and that's what won Bill the Nobel Prize. Those assumptions include the ability to borrow and lend to an unlimited extent at the same risk-free rate for all investors having the same expectations of return and risk for all assets, and market pricing being efficient. But as these models gained popularity in academic circles, indexing started to become adopted as a portfolio management technique. Other weighting schemes weren't even tried because cap weighting had been proven to be correct. Now, as indexing gained assets, performance that differed from the benchmark began to be presumed as evidence of sloppy implementation. This led to an obsession with tracking error. It's something that the indexing community overtly encourages. If there's any tracking error, it is sloppy implementation, which means that index fund managers seeking to add modest incremental return through careful trading as the index funds change composition wind up being branded as sloppy, even if their tracking error is positive. So tracking error now trumps alpha, even to the point of shunning any quest for alpha. That quest is seen as folly. As indexers crowd their trading into the effective date for any index change, remember, to reduce tracking error, the closer you trade to the closing price on the date of change of an index, the less your tracking error will be. So as indexers crowd their trading into that effective date, they move share prices a lot. One of the things that I find genuinely offensive about the indexing community is the claim that they don't move share prices. That's complete rubbish. The trading cost became hidden starting in 1989 when the S&P began to provide a grace period. They would announce a change and an effective date that might be a few days or even a couple, 3 weeks into the future. So that grace period meant that indexers could change their holdings in the portfolio just ahead of the index itself being changed, so that if they moved the share price, it was transparent, the trading costs were hidden. Now, one of the hidden consequences of that is that any indexer who wants to beat the market, hence beat their peers, can do so with some surprisingly simple expedients. I'm going to go through some of these later in the presentation, but they're very simple and they're very powerful. However, to do so, you have to accept modest tracking error, including periods of modest underperformance, and you have to be willing to be branded as a sloppy investor with sloppy implementation in order to pursue these expedients. Now, Bill Sharp wrote a famous paper in the early 90s called The Arithmetic of Active Management, and it stated some pretty basic truisms. The paper's been attacked for its modest assumptions that take it away from being fully, perfectly correct. But it is broadly correct, and that is that index funds basically own the market portfolio. Now, it may not be the complete market portfolio, but it is a market portfolio. If you take their holdings out of the market, what's left is the assets owned by active managers, individual investors, and those who closely hold companies. And collectively, that's going to be the same portfolio. The result is that index funds and active managers have the same gross performance before fees and trading costs. Because indexers have lower fees and much lower turnover, the indexers therefore must win for the end customer. So far, so good. This is actually correct, and it's the most powerful argument indexers have against the active management community. This was taken as a truism for a long time. We did a study last year in which we looked at mutual funds in the U.S. going back over a quarter century, and we did find that indeed, using 4,254 funds, all mutual funds that have existed in the last quarter century, looking at their month-by-month returns, no survivorship bias, all funds included, we found that the month-by-month returns matched the cap-weighted market with a shortfall of just 20 basis points. Active managers, shortfall of 30 basis points. Passive managers, a gain of 10 basis points. These are not statistically significant differences, and they're not economically meaningfully different. But Vanguard 500, Jack Bogle's baby, outperforms by 0.1% before fees, underperforms by 0.1% after fees. Now, their fees aren't 20 basis points, but a quarter century ago, they weren't the current very, very low fees that we see today. Active managers, 30 basis point shortfall before fees. That's probably their trading costs. And 1.6% after fees. Ouch. That's a big shortfall. Before fees, they match. After fees, passive wins. And look at the difference between mutual funds and ETFs on this table. 3,900 mutual funds, average return 30 basis points behind the market. 354 ETFs, average 30 basis points ahead of the market. Net of fees, mutual funds average minus 1.5, ETFs average minus 0.1. Isn't that interesting? Funds and ETFs. ETFs are mutual funds. They're just mutual funds that can trade intraday and that can be funded and defunded using creation units. Those are the big differences. And yet, there's a very large tangible difference in net of fee outcomes. So, there we see one of the first hints that there's room to do things better. Now, the story is that funds that track cap-weighted indexes have enormous, some would even say unlimited, liquidity and capacity, have broad market participation, have low turnover and trading costs, provide transparent portfolios with low fees and a track record of beating active managers most of the time. Well, the first three of these are not strictly true. We'll come back to this in a little while. In the beginning, index funds were derided as un-American because there was no effort to judge the fair valuation of individual companies, and that was one of the early criticisms. Well, there was even a wonderful paper called Indexing is Worse Than Marxism, which made the case that the failure to try to identify fair value meant that index funds were serving no useful function in capital allocation in the macroeconomy. That may be true, but as long as they're a minority of the investing world, you're still going to have lots of people focusing on capital formation. But in any event, moving along, modern investor has many opportunities outside the S&P 500 or the 500 largest U.S. companies. So it invites the question, what is the true market portfolio? Take a look at the top 500 on this graph as a fraction of the U.S. stock market. Back in 1965, it was about 96%. There were only a few hundred more stocks than 500 even available to trade back in 1965. By the time of the launch of the S&P 500, it was about 80% of the market, reaching a low in the late 90s of about 75%, and now ticking well up above 80% because fewer and fewer companies are publicly traded. Interesting evolution, but broadly the S&P is about 80% of the market. So one of the critiques is S&P 500 isn't a pure market portfolio because it misses 20% of the market. It misses 60% of the world market. And capital asset pricing model applies and is provably true only if you make some heroic assumptions and if your market portfolio is the investable collection, the collection of all investable assets globally. Well, that's clearly not true of any U.S. index fund. Now, one of the common arguments for indexing is that markets are efficient and stocks follow a random walk. It's just not true. DeBont and Thaler back in 1985 showed that stock returns exhibit a strong pattern of mean reversion. They looked for the 25% of the market that had performed worst and 25% of the market that had performed best over the prior 3 years and asked what happened over the next 3 years. And they found that there was indeed a 25% spread in the wrong direction, buying the losers, beat buying the winners by 25% over 3 years. Note that most of the gains happened in month 1, an 8% gain, month 13, a 6% gain, and month 25, a 4% gain. Well, that's awfully interesting. What that suggests is that there's a seasonality here. Well, what's going on? Why the seasonality? It's because they started each investment December 31 of 1 year, held it for 3 years, and they did non-overlapping periods so that there were 16 3-year creation periods, 1929 to 32, to create a pair of portfolios to measure over 33 to 35, on up to December 1980, the end of their study. We decided to replicate their work and to do it out of sample, but the in-sample comparison, where we go all the way back to 1930, we're using rolling 3-year spans. Now, if you use rolling 3-year spans, the January effect almost disappears because you have one span that goes January of 1933 to December of 35. The next goes from February 33 to January 36, and so forth and so on. But we find almost identically the same result, including 30 years that are out of sample from the Bont and Thaler results. And if you look at just those 30 years, you get almost identical results. Bottom line is, when you use the rolling spans, you can see that the relationship is highly statistically significant, almost monotonic, and losers beat winners relentlessly. So, what happens in an index fund? Index funds largely own the market, but they do trade. And their trading has a strong characteristic of buying high and selling low. The trading of index funds is slight, 2 to 5% typically, except for specialty indexes like value or growth or small cap. But the turnover that they do is very, very expensive. Stocks that come onto S&P 500 or Russell 1000 come onto those indexes because they've soared in market capitalization and are no longer small companies. They soar onto the list usually in a context of trading at massively higher multiples than the market. That's when the index funds buy. The stocks that are deleted usually are corporate actions, mergers, acquisitions, that kind of thing. But a large minority, about 40%, are discretionary deletions. Those discretionary deletions are usually companies that have been floundering for years and years, have fallen off of the largest market capitalization list, are deeply out of favor, and are trading really cheap. So index funds buy high and sell low. We can quantify how much they buy high and sell low, and we can quantify what it costs them. Their largest holdings are also their most expensive. Some of these deserve their high multiples, some don't. And the result is that those largest holdings are the ones that most reliably underperform the index. Each of these problems is an opportunity to create a better index fund. It's interesting to note from history that broad market indexes were not designed or intended to be investment strategies. They were created with a simple purpose to measure the performance of the broad stock market so that you could know how you were doing relative to the market. And yet the 5 largest mutual funds and ETFs in the United States are now all index funds tracking core portfolios. That's $1 trillion in 5 funds. My goodness, that's a lot of concentration in large cap U.S. index funds. And these funds in turn have large concentration in the FANG stocks. They will own them no matter what their valuation levels. Let's back up the clock to 1954 and do a little thought experiment. Fortune magazine decided to list the largest companies in the United States, the Fortune 500. Selected based on sales and ranked based on sales. What if Fortune had decided, we're going to all this trouble to identify the 500 largest companies by sales. Why don't we create a Fortune 500 index that tracks the performance of these stocks weighted by sales? The notion of capitalization weighting hadn't yet been really introduced. True, the S&P 60 was capitalization weighted, the Dow was price weighted, but the notion that cap weighting is the right way to do things was not yet generally accepted. It would have been just as natural to weight it by sales and not market cap. What if index funds were introduced in 1973 anyway, and the S&P had launched in 57 as they did? The index fund managers would automatically have chosen the Fortune 500, not the S&P 500. Why? Because it performs better. And it performs better partly because of a value tilt and partly because of a rebalancing in which you're constantly selling the companies that have gotten ahead of their fundamentals and buying the companies that have lagged behind their fundamentals. The result is that an investor in a sales-weighted index fund launched in 1973 would have more than twice the wealth today of those investing in the S&P 500. So there's nothing wrong with indexing, but this does suggest that indexing based on market cap has performance that's pulled down relative to the average stock when you use a weighting scheme for the average stock that's not cap weighted. They do trade, and they trade significantly. During the tech bubble, there was a frantic turnover averaging 8% over the span of 3 years, 98 to 2000, in which the S&P was constantly trying to reconstruct the index to match a rapidly changing economy and a rapidly changing roster of favorites in the market. The long-term average was 4.5%. With $4.2 trillion tracking the S&P 500 index as of the end of 2017, that means $185 billion worth of stocks are being sold and $185 billion bought every single year. Now that's a lot of trading. The costs are incurred between the date when a change is announced and the effective date, and the result is that the funds won't underperform the index because the index makes the change after the mutual funds have traded. Isn't that interesting? Why did they make the change back in 1989? We can only speculate, but with some confidence, I would suggest that index funds were tired of underperforming the index, even modestly, by dint of the index changes taking them by surprise, and lobbied the index companies to create a grace period. And that's not nefarious, it's just customer service. The customers of the index companies were the index funds. Before October 1989, changes to the index were implemented on the date of announcement, and they were announced after the market close. So what we found was that index funds generally underperformed the indexes until 1989. After October 1989, S&P began pre-announcing index changes. These days, pretty much all the cap-weighted index providers pre-announce their index changes. So tongue-in-cheek, I note, busted is their collusion to hide the true cost of the index funds. I don't think it's nefarious intent, but the trading costs are now hidden. This, interestingly, leads to a price war. The price war in indexing is tremendous. Index funds are now available for 3% or even a touch less. My goodness, that's cheap. I've read recent reports that suggest that the zero bound might be reached in a handful of years, zero-fee index funds. It doesn't mean zero costs. There are other costs, and the trading costs dwarf the fees. We constructed, we had trouble getting our hands on S&P index changes directly, and I fully understand why there was reluctance to share that. But we went to use Siblis research, public research, on additions and deletions, and went back and recreated the S&P 500 using the addition and deletion history, starting with today's holdings and working back. What we found was 1,000 discretionary additions between 1970 and March of 2017. Another 100 non-discretionary additions. Those are spin-offs. ATT was broken up in 1984, I believe it was. Bingo, you had 7 additional stocks added to the index. Deletions, there were non-discretionary deletions, nearly 700 of them, mergers and acquisitions, but another 400 that were discretionary. We're going to concentrate our attention on the additions and the discretionary deletions and look at how index funds buy high and sell low. Firstly, why do they buy? They buy because a stock has soared and it's now embarrassing that it's not on the index. So recently we saw Twitter added. Not widely reported, the stock rose 25% in the 2 weeks surrounding the addition period. Most of it before the effective date, but a good chunk of it after as well. What we find is that historically the additions outperform the market by 36% in the year before they're added, by 1% in the week before they're added. These are booming stocks performing wonderfully that are being added because they've performed well. The discretionary deletions are the opposite. They've underperformed by 28%. Non-discretionary M&A, corporate actions have often outperformed, and that's why the corporate action, but they outperform by less than the additions. Now, we also find that the price-to-book value of additions tends to be twice that of the market. Discretionary deletions, 1/3 off. PE ratios, additions, twice the market average. Discretionary deletions, often because of depressed earnings or even negative earnings, wind up having PE ratios that aren't all that cheap. But price to cash flow and price to sales, they're trading at deep discounts. If you average the relative valuation using 5 measures of valuation multiples, we find that the additions trade at an average of 170% premium to the market, discretionary deletions a 16% discount to the market, meaning that the additions relative to discretionary deletions are trading at triple the valuation multiples. Wow, that's a big difference. Then what happens? During the grace period, after it's been announced but before the rebalancing date, the effective date, additions beat deletions by 6%. Inclusive of the rebalancing date, they win by 9%, meaning that there's another pickup in returns of about 3% for additions relative to discretionary deletions just on the effective date alone. Now, the index funds trade mostly very close to the close on the effective date. That's interesting. They do that because they're terrified of tracking error. Well, who's pushing the price up? Part of that is hedge funds facilitating the transactions of the index funds. Part of that is simply an awareness that these stocks are being added and a reluctance to sell until the price has gone up. In the one day after the rebalancing, this pattern continues. One would assume that maybe this is because of some of the index funds doing some final top-up trading to finish the rebalance. But additions beat deletions by 1.5% in the day after the rebalancing. A year later, the additions have underperformed by 1%, meaning they've underperformed by 2 relative to the day after. And deletions have outperformed by 21%, meaning 22% from the day after, for a spread of 2,200 basis points. That's real money. Within a week, the average discretionary deletion is already outpacing the average addition. Looking at this, one might infer that delaying your trades by a month or a quarter or a year ought to add value. We're going to test that, and of course, it does add value. One might also infer that a strategy of buying the deletions a day after they've been deleted is a way to beat the market by 22% a year. We did not test that because it would be a very concentrated and very strange portfolio. But the evidence is clear that it would have won in the past. The performance reverses within the week after the effective date. The red line traces the performance of the deletions. The blue line traces the performance of the additions. Isn't that interesting? Now, when we go back to the period before 1989, notice the scale on this next graph is a very different scale. Of course, the additions outperform handily. The deletions, not so much. And the performance of additions and deletions in the year after the change is not statistically significantly different. So perhaps before 1989, there was less pressure from index fund managers to include glamour stocks, hot, trendy, popular stocks, those past years' equivalent of the Twitters that we see today. And the index committee was perhaps a little more sensitive to seeking to minimize buy high, sell low trade impacts. I don't know. This is all speculation on my part. But then the question is, can we fix indexing's buy high, sell low travails? And the short answer is we can. We replicated the S&P 500. We used ETF end-of-year holdings and rolled back using Siblis Research database for additions and deletions to construct a facsimile of the S&P 500. The fit with the live S&P 500 is good. The correlation is 99.97%. The cumulative performance is 3 basis points different, and the cumulative volatility is 3 basis points different. So I think that's a pretty darn good replication. We then replicate trade on announcement. How would the S&P 500 have performed if it continued after 1989 to trade at the close of the announcement date prior to the announcement? Now, index fund managers could not do this without moving the price, but isn't this the correct benchmark? And how big a shortfall do index fund managers have relative to this? We then took advantage of the fact that losers beat winners in the months after the change has been made, and we suggest lazy indexation. Delay the index trades by 3 months or 12 months. Just put a Post-it note on your calendar. The index added Twitter and deleted Monsanto. Monsanto wasn't a discretionary deletion. The stock itself is going away. But when it is a discretionary deletion, put a Post-it note on your calendar. Do this 3 months from now, or do this 12 months from now. What do we find? The replicated S&P is the benchmark on this next graph. The replicated trade on announcement S&P outperforms the actual S&P by 3.5%. All of that outperformance is, of course, after 1989. Now, what that means is that if the S&P had continued its policy of announcing changes and making them retroactive to the immediately preceding market close, that index funds would have underperformed the S&P by 3.5% over the last 29 years. It's not a huge margin. It's barely into double digits, but it is measurable. It is statistically significant. If instead we just got lazy and implemented 3 months after the S&P was changed, we get the gold line, we beat the market by 2%. And that's actually pretty relentless. It goes all the way back to 73. Or we could be very lazy and delay all trades by a year. That adds 5.5% since 1973. But a large slug of that, 4% of that, was concentrated in the peak of the tech bubble and the aftermath unwind of the tech bubble. Replicating additions of hot, frothy tech stocks a year late turned out to be massively beneficial in 2000 and 2001. Put into numerical terms, what does this mean? The official S&P had a return of 10.48 since 1973, the replicated 10.51. The volatility was almost identical. A trade on announcement S&P performed 12 basis points better than the S&P. Lazy replication beat the S&P by 9, and very lazy replication beat it by 16 basis points. These are pretty good margins. The information ratio is barely statistically significant, but it is statistically significant. We then looked at the question, what if we were really simplistic, replace the whole S&P committee with an implementation that just chooses the top 500 by market cap every year and does nothing else? The changes are all take place and are easily predictable weeks ahead. And what we find is that the performance is 1 basis point worse than the S&P, the volatility 5 basis points higher. So pretty much identical returns, but not quite. If you had banding, where a stock had to rise 40% above the threshold to make it into the 500 before it would be added, and 40% below before it would be dropped to reduce turnover, well, that pushes the return up and the risk down, and the turnover drops from 5% to 4%. Let's suppose we don't want to chase the hot new stock, and so we choose the top 500 by 5-year average market cap, but weight them by market cap, not by 5-year average, weight them by market cap. Just choose them by the 5-year average. Now you've added another 10 basis points, and you've reduced the risk. If we do that with banding, now you've added another 8 basis points, and you've reduced the risk even further. So can we do better at index fund construction and management? Oh my goodness, yes we can. Here what we can see is the top 500 by market cap compared to the replicated S&P 500, slight underperformance. Top 500 by cap with banding, almost identical performance. 5-year average market cap adds 4%. 5-year average market cap with banding adds 7%. So this is the first clue that maybe we can do things better. I also noted that index funds, their largest holdings hurt them. Let's dive into that a bit. Here's an exhibit that goes all the way back to 1980, year by year back to 2008, 10 years ago, and decade by decade back to 1980. What I want to draw your attention to, and this is a little bit of an eye chart, so forgive the small font, but the stocks that were top 10 in the world by market capitalization, IBM, ATT, Exxon, Standard Oil, Schlumberger, goodness, there's a lot of oil stocks there. Well, that was the oil bubble. How many of those 10 were still on the list in 1990? 2. 8 fell off the list. All 8 of those underperformed the market during that 10-year span. Both of the ones that survived underperformed. So 10 out of 10 underperformed in the next 10 years. Ouch! Those are your 10 largest holdings, and 10 out of 10 underperform. The 2 survivors are ranked number 8 and number 10 in 1990. Now you have a totally different list. Oh my goodness, there's a lot of domination by Japanese companies. 8 out of 10 are Japanese companies. And most of those are bank stocks. Well, this is the peak of the Japan bubble. How many of those survived over the next 10 years? 2. ExxonMobil and NTT. One of those 2, ExxonMobil, outperformed. So from the 1990 portfolio, your 10 largest holdings in a market cap portfolio, 9 of the 10 underperformed. In the year 2000, what do we see? A totally different list, heavily dominated by tech stocks. 5 of the top 8 stocks on the list are technology companies. And that 5 out of 7 concentration is quite remarkable. Bespeaks a concentrated bubble. What about 10 years later? How many of those 10 survived? 2 again. Microsoft fell down the list. It underperformed. ExxonMobil again was a survivor. It outperformed. 8 fell off the list. All 8 underperformed. So in the year 2000, your 10 largest holdings in a global index fund, 9 of the 10 underperformed. As you go through year by year, you see a lot of rotation. On average, 3 stocks disappear and 3 stocks are added. You can be guaranteed that the 3 stocks that fall off the list, all of those 3 underperform all of the 3 that are added to the list. It's the performance difference that makes the change in composition. So your largest holdings include 3 that are assuredly underperforming, and your 3 that are outperforming enough to get onto the list. Not one of those 3 would be among your 10 largest holdings before they soar. This is the Achilles heel of cap weighting. Where were we at the start of this year? 7 of the 8 largest market cap companies were tech-ish companies. Yes, they were in slightly different sectors. Amazon in retailing, and Microsoft and Alphabet and Apple, very different industries. But they were all popular, frothy, expensive tech companies. When have we seen that kind of concentration? 7 of the top 8. The only previous time was 1990, in which 7 of the top 8 were Japanese stocks. What happened after that? We know. This is even more concentrated than at the peak of the tech bubble in the year 2000. We did a paper back in 2012 entitled Too Big to Succeed, a play on the notion that some banks are too big to fail. Well, when you're the top dog, largest in your sector, you suddenly get a target on your back and on your front and on your head. And everyone's taking shots at you. Regulators want to put a notch in the barrel of their gun. Your competitors are taking shots at you and even using the regulators to help make their case that you're playing unfairly in your field. So what do we find? We find the global top dog underperforms the global cap-weighted index by 10% per year over the next 10 years. We find that on a 1-year horizon, it underperforms by 12% a year, winning only 1 out of 3 years. The top dog in each sector underperforms by 5% per year, compounded over the next 10 years, with only 1 out of 3 winning. So we find that the top dogs, whether it's by sector or by country or worldwide, the underperformance is relentless. So, do I want to hold a portfolio in which my 10 largest holdings have a 95% chance of underperforming over the next 10 years? I don't think so. We compare the performance of 5 different portfolios, and I don't suspect any index funds are going to want to do this. But exclude the single largest market cap stock in the world. Exclude the 10 largest, or exclude the largest market cap stock in each country. What we find is that the performance of the top dog portfolios, the developed world index on the left, takes you to 32 times your money since 1980. The global top dog, the number 1 stock in the world, takes you to 1 times your money. You've underperformed by 97%. You've lost 97% of your wealth relative to the world if you just hold the largest market cap company in the world. If you hold the global top 10, you made 8 times your money, 1/4 as much as you did with the market portfolio. If you own the country top dogs, you wind up 7 times as wealthy, roughly 1/5 as wealthy as with the market portfolio. This is shown on the scale on the right in terms of relative performance, and you can see it's pretty darn relentless. What if we exclude them? You wind up with the performance of the developed world on the black line on the left, the performance excluding country top dogs, global top dogs, and global top 10 in that cluster of lines above the black line. And to make it easier to see the difference, you can see the relative performance on the right. A little less relentless, but still pretty powerful. You just exclude the top 10 stocks in the market, you wind up 17% ahead of the global market portfolio just by excluding them. And there aren't many big drawdowns. So, just to conclude, I'm not suggesting anyone will launch an index fund that excludes the largest holdings, but de-emphasizing them a bit, weighting them by their 5-year average market cap, these are things that could be done. The arguments in favor of traditional passive indexing seem compelling, but index funds do buy high and sell low. Index funds do incur trading costs which are not modest, are not near zero. They're in fact vast. The stocks that are discretionary deletions outperform the stocks that are discretionary additions by over 2,000 basis points in the year after the change. And the additions outperform the deletions by 900 basis points in the span between announcement and effective date. That is enormous trading cost. There's abundant evidence that if we add or remove a stock from a major index, it can have a significant impact on the stock's short-term performance. And what's interesting is that differences in fees of 1 or 2 basis points define the competition between index funds, but it avoids focusing on the buy high, sell low dynamic of the indices that lose investors tens of basis points per year. Now, tens of basis points isn't hundreds of basis points, but it is enough to matter. Index funds can beat their peers by trading well after a change is made, by engaging in banding, deferring trades that are in a wide range of the market cap cutoff, by cutting exposure to top dogs, and these are just 3 of the easiest ways to add a modest, reliable alpha. I do not think any of the major indexers will do this. They worry too much about tracking error, but some scrappy upstart index fund manager trying to carve out a niche as a better index fund manager has the opportunity to do so. Thank you for your time. Let's open it up for questions.
Thank you, Rob. While we're compiling the questions for the Q&A segment, I'd like to take a moment to highlight a couple of the videos we've recently posted to our website. We recorded all the speakers at our first Research Affiliates Advisor Symposium event we held in March. We have uploaded all the sessions to our website, and I'd like to highlight 2 of those. In Is Your Alpha Big Enough to Cover Its Taxes?, Rob revisits one of his seminal papers from 1993 in which he examined the impact of turnover on active managers' after-tax returns. His presentation covers an update of his research looking at the impact of low-fee, low-turnover smart beta products and ETF vehicles. In the other video, Don't Get Fooled Again by Cam Harvey, Cam's a finance professor at the Duke Fuqua School of Business. He's also a member of the Research Affiliates Academic Advisory Panel. Cam walks through the reasons why investors should be skeptical of back-tested performance, starting with an evolutionary explanation of why we have a natural tendency to make false positive errors. Again, each of these videos are available at researchaffiliates.com. With that, let's move into the Q&A section of our webinar.
By the way, I would endorse the Cam Harvey video. I saw him present live, of course, but watching the video just was a reminder of how truly brilliant the paper is, the presentation is, and how the quant community falls into horrific data mining traps. And it's a very sobering look at the quant world today.
Thanks, Rob. So with that, why don't we go ahead and move over to the Q&A section. I'm looking through some of these questions. We've got some common themes. Going back to, we'll start backwards. We'll go back to the top dogs that you covered near the end of the presentation. Given the dependence on top dogs that you cited that's prevalent in cap-weighted indices, would you recommend that investors benchmark the performance of the active managers they've selected against a non-cap weighted strategy such as equal weight indices or your own fundamental indices, or do you still believe that cap weighted indices should remain the default benchmark?
The market is cap weight. I'm totally fine with the notion that cap weight is an appropriate benchmark. I think the trade on announcement index, which no one publishes, would be a more accurate benchmark. We did have one early client with fundamental index who not only embraced the strategy, but put all of its active managers on a dual benchmark, fundamental index and cap weight. And basically the rationale was if you're beating both indexes, you're a hero. Applause. If you're lagging both indexes, there's not going to be a lot of patience. And if you're in between, you're okay. We're watching you. The active managers were so upset that within 3 years they abandoned the dual benchmark. Putting in place a benchmark that's tough to beat may be the right thing to do for choosing your active managers, because really they ought to beat anything that is an easily replicable strategy. But it's politically unacceptable in most organizations to set a benchmark that's tough to beat.
Makes sense. A similar question, I'll be in a little bit different direction from, this is a specific one from, I'm assuming, an institutional investor. He or she mentions that you highlighted their issues with grading implementers solely on tracking error. How would you suggest that institutional investors that are employing passive strategies, how would you suggest that they grade the efficacy of their passive implementers? Would you focus on excess return with a wider range for tracking error? What would you recommend?
Well, any tracking error will sometimes be negative. And so objectively, quantitatively measuring skill is actually fairly tough unless you're looking at very long spans of time. I think the right way to do this is in the manager selection process. Ask the manager, do you seek to replicate the index with near zero tracking error? Or do you seek to beat the index through simple expedients that involve a little bit of tracking error? If the latter, what are the expedients you're using and what kind of tracking error would you expect us to tolerate? That gets you away from the notion that tracking error is inherently evil, even if it's tiny. And it also winds up, if a company says we're really replicating, we're not trying to add value, and they have tracking error, then it is sloppy tracking error. So you want to distinguish between skill-based tracking error that'll occasionally be negative and sloppy tracking error. You don't want the latter. You may want the former.
Great. So good suggestions. So this is a discussion you want to have up front with your implementer and get a feel for their philosophy or their approach.
Yeah. Incidentally, I presented this paper at the FTSE WIF conference, and in attendance was a fellow who had been manager of one of the 5 largest index fund management firms in the world for about 20 years, and he said that they did some of the strategies that we were advocating. They did employ them, and the marketing team finally came to them and said, stop it, because they were losing searches due to their 15 basis point tracking error, even though the tracking error was delivering almost 10 basis points of alpha.
You know, related to that, this idea of finding additional excess return by going beyond the stated weights and adhering to a very tight tracking error range. We got some questions related to the additions and deletions data you showed, specifically, I'm aggregating across a few of them, but there were some specific questions related to your thoughts on implementers attempting to predict additions and deletions before announcement.
When it comes to the Russell indexes, that's pretty easy. The only secret in the Russell process is their float adjustment. They don't publicize how they do their float adjustment. So you can guess which stocks are going to be added and which deleted with about 90% accuracy by a month ahead of the rebalance. There are lots of people who've been pursuing that strategy since, I remember back in the early 90s. Discussions along those lines. So there are people who pursue exactly this kind of strategy. It's tougher with the S&P because the additions and deletions aren't on a systematic cycle. With Russell, it's once a year in June. It's when the S&P committee decides to make a change, which could be triggered by a corporate action. Monsanto ceased to exist. Therefore, let's find something to replace it. You look around, what's the largest cap stock that's not on the list? I'm guessing Twitter was one of the top 3 or 4. Might have been the number 1. And what's the popular, trendy stock that's missing from the index? Well, Twitter qualifies. So you could probably predict that. I noticed that Twitter rose by 8% in the week before the announcement. Interesting. It rose by 15% during the announcement period, and then it rose by another 6 or 8% after that. So did index funds move the share price? Not necessarily on the moment of their trade, but some people were front-running that trade big time. And the expectation of the change moved the price start to finish over 25%. That's big, and that's a trading cost. It's a trading cost that's borne by the index funds, and it's borne by the index itself because they pre-announce the change.
Related to this idea of index funds pushing up the price or the price of some companies, we received a few questions going back to the FANG stocks. Questions related to effectively, what's your view on the role of index funds and active managers in combination, and from the standpoint of driving up the price of these stocks that certainly appear to be in a bubble?
Yeah. We wrote a paper earlier this year entitled, Yes, It's a Bubble, So What? And the point of that paper, firstly, and probably most important of all, was in giving us a robust, reasonably objective definition of bubble. People use the word left and right without ever defining it. That definition was you would need to make implausible, not impossible, but implausible assumptions to justify today's price using any conventional valuation model. And part 2 of the definition, the marginal buyer today has no interest in those models, has no interest in objectively gauging what the valuation is. Several of the FANG stocks flunk that definition, some don't. Microsoft and Apple have large cash reserves, valuation multiples that are high but not extravagant. And so some of the FANGs qualify for bubble, some don't. The thing in the paper, Indexing is Worse Than Marxism, that I found fascinating was the notion that the indexes, by definition, are valuation indifferent owners and valuation indifferent buyers when a stock is added to the list. Now remember, the average stock added is trading at 170% premium to market multiples. So you're paying for a lot of future growth that hasn't happened yet. That's a little worrisome. So I think when index funds have enormous inflows, they will have the effect of pushing up valuations on their largest holdings and their priciest holdings. And when those flows stop, you could see substantial mean reversion. Those flows are partly being accelerated by the fact that it's been a growth-dominated market literally for the last 12 years. And over that 12-year span, with growth beating value by 2.5% per year, cap weighting puts most of its money into growth stocks because the weight is directly proportional to the valuation multiples. So when and if we see a reversal of the flows, watch out for valuation mean reversion between growth and value. If inflows continue to accelerate, not just continue, but continue to accelerate, that can augment the valuations because you have a valuation indifferent buyer who just doesn't care what the FANG stocks are priced at. They have a certain market cap, therefore we buy them.
Well, I think we've got time for one more question. A couple people have mentioned in their questions that we've spent a lot of time picking on cap-weighted indices. We haven't talked about non-cap-weighted indices as well. So you've gone into pretty exhaustive detail on some of the flaws with the cap-weighted indices. What are some flaws generally that we should look out for when evaluating non-cap-weighted indices?
Well, firstly, when you say non-cap-weighted indices, does that mean the whole panoply of smart beta strategies, or does it mean indices that have some sort of broad market weighting like fundamental index or equal weight? With equal weight, you're equal weighting what index? If you're equal weighting the S&P, you're still going to be buying high and selling low. It's just going to be in 1%, in 1/5 of 1% chunks, 1/500th of the portfolio. So it's not going to have a huge impact, but it will still have the drag associated with that. So that's a cautionary note. Interestingly, if you equal weight RAFI, the fundamental index, you get distinctly better returns than equal weighting the S&P. RAFI, the biggest cautionary note, is actually also the simplest, and that is it's an index that's weighted in proportion to the company's economic footprint in the macroeconomy, not weighted in proportion to its market cap, hence its popularity. So relative to the economy, fundamental index is studiously neutral, and cap weighting is a growth-tilted, momentum-chasing, popularity-weighted index. Why should you expect as big a risk premium for something that's growth-tilted, momentum-chasing, and popularity-weighted? Fundamental index, relative to the market, looks like a value-tilted, anti-momentum strategy that overweights the unloved stocks in proportion to how unloved they are. So it's an inherently contrarian strategy relative to the market. It has inherent buy low, sell high discipline. If a stock tumbles relative to its fundamentals, you buy it. If it soars relative to its fundamentals, you trim it to return yourself to the fundamental weight. The result is it will require patience during periods when value is being savaged. What we find is that the fundamental index beats the value indexes pretty relentlessly. But relative to the cap-weighted market, if you're in a growth-dominated market, we'll often have a shortfall. If you're in a value-dominated market, we'll often be just shooting the lights out. So it's a strategy that requires patience through the growth value cycle.
And just a follow-on to that, I know you often talk about the focus you had on implementation costs when you were developing RAFI. Is that an area you would highlight when evaluating some of these smart beta or non-cap weighted strategies?
That's a really neat question. Yes, absolutely. Fundamental index has just about the lowest turnover of any of the smart beta strategies. It is the most inherently contrarian, buying low and selling high, and it is it's not necessarily the most value-oriented, but it's distinctly value-oriented. And the trading costs are an interesting thing. The trading costs you incur are proportional to the size of the trade, inversely proportional to the liquidity of the stock, how much it trades. And so if you double your turnover, you're going to double your trading costs, all else equal. If you spread your trades among twice as many companies, you're going to chop your trading costs in half. If you trade heavily in smaller cap names, you're going to boost your trading costs drastically. What trading does a cap-weighted index fund do? Most of the trading's at the bottom of the list, additions and deletions, where the trading costs are high. It's concentrated. You're trading only a handful of names. The turnover is extremely low. That's why the trading costs are modest. That's the only reason the trading costs are modest. Fundamental index spreads its trades across the whole 1,000 companies. You're trading most of the 1,000 companies. You're buying what's out of favor and trading cheap. You're selling what's popular and on a roll. So finding the other side of your trade is easy. I would argue the capacity for fundamental index is larger than the capacity for cap-weighted indexes. I don't know that I'll get a lot of support for that assertion outside of the smart beta community.
Well, I think that's a good way to go out with a bang. So given that we're out of time, I think we're going to need to wrap up there. Rob, thank you very much. We certainly appreciate everyone's interest and time that you've taken today. We'll be sure to send all the questions that we didn't get to our relationship management team, who will get back to each of you with a response. And another note, a replay of this webinar will be available on researchaffiliates.com by this afternoon. If you're not part of our mailing list, please sign up on our website. Everyone on the mailing list will be notified when the replay becomes available and the materials are up on our website. Thank you again for spending the last hour with us here at Research Affiliates. And finally, before you go, we always appreciate feedback. We have a short 1-minute survey that will appear on your screen shortly. Please share your impressions of today's webinar and let us know how we can make these even more useful for you in the future. Thank you again for taking the time to spend with us today.